To you both, guys. David, clearly the market is still in kind of this defensive crouch, consumed with the likelihood of a slowdown, perhaps giving way to an outright recession. At the same time, the Fed seems a bit locked in to waiting for more relief on inflation before it can itself ease back off of its rate tightening campaign. What does an investor do with that backdrop right now?
Well, what the investor is doing and what everyone's doing right now is repositioning their portfolios. And obviously, that repositioning should be really in a defensive posture. It doesn't mean getting out of equities, but it means getting into dividend equities into different sectors of the market that are more defensively positioned as we go in the last 6 months of the year. And what I think is going to happen now is that we're looking ahead 6 months. You're already seeing consumer demand drop. You've seen that in both luxury and non-luxury areas. You've seen it in retail. And what that portends is a decline in employment beginning, probably 6 months from now, the beginning of 2023. So we don't see a recession this year, but there's a possibility of one next year. And really what the Fed has to make a determination of, and this is what the hard call is whether or not just setting expectations where they are, raising rates, and telegraphing what they're going to do, that has already been sufficient to really slow down the economy. That will reduce inflation over time, but it can't reduce the cost of wheat or the cost of oil quickly because all they can do is bring down aggregate demand. So the question is, will the Fed actually realize that it has had a large portion of the impact that it wanted to have just by making the announcements and following through on them? If it does, you can avoid a recession. If it continues and actually extends its sort of, fight against inflation, that could end up being a recessionary signal for 2023.
And Delano, I mean, given that all of that and the fact that stocks in general, in fact, majority of them done a lot worse than the indexes have so far. So there's this instinct there, perhaps, to say that maybe a lot of the bad news might be priced into a lot of individual stocks. At the same time, it's treacherous to kind of get too far ahead and anticipate the turn and things getting better before we've actually lived through what the Fed's likely to do and whether, in fact, this recession comes to reality. So how would you be operating right now?
Yeah, Mike, you make a really good point. I think, if we're going to see a soft landing, which is going to be very hard for the Fed to achieve, but if we're moving closer to that probability, then investors might be in a stronger position and can be less defensive. But, I still think we're obviously in a raising environment, and now the focus should be for investors on earnings, right? And earnings projections are still pretty rosy. If you're looking at what we have in the S&P 500, they're still seen to rise 8.8% this year and 9.3% in 2023 after we had a strong 2021. So those forecasts haven't come down, right? And so investors can look at that as a potential next leg downward if we see those projections on EPS, on revenue growth for the S&P 500 companies and for all companies overall to start to go down. Then investors would still want to stay very, very defensively positioned in your healthcare positions as well as your staples. But, if that eases, there's potential for a fourth quarter, which has historically been a decent quarter after a lot of leg downs to the market, to be stronger there, Mike.
Shepard Smith here. Thanks for watching CNBC on YouTube.